All right, welcome to the explainer. So you're thinking about investing in silver, right? But the whole idea of, filling your basement with actual metal bars, that's a bit much. Well, today is for you. We're going to break down two of the most popular ways to get into silver. And guess what? You won't need a single safe. And this question really gets to the heart of it, doesn't it? I mean, you see the potential in silver, but dealing with the logistics, buying it, storing it, insuring it, wow, that can be a massive headache. So how do you jump in on the action without all that hassle? Well, let's dive into the modern solutions.
Okay, so before we pit these two investment tools against each other, let's take a quick step back. Why are so many people drawn to silver in the first place? Because, it's way more than just a shiny metal.
I mean, for literally centuries, silver has been the way to protect your wealth. It's a classic hedge against inflation, right? Its value isn't just tied to the US dollar or any single currency. Plus, and this is huge, there's massive industrial demand for it. We're talking everything from solar panels to all the electronics in your pocket. You put all that together and you've got a classic way to diversify your portfolio, a safe haven asset that people run to when things get a little shaky. And this is where things get really interesting for us today. The world of finance came up with a solution for that whole physical storage problem. They created these products that offer two totally different ways to get to the same goal, investing in silver. So let's meet our contenders. All right, first up in the ring, we have the exchange-traded fund, the ETF. Now, if you've ever bought or sold a stock, buying an ETF is going to feel super familiar, almost exactly the same. The whole idea here is actually pretty simple, but it's really powerful. So imagine this. A company goes out and buys a huge amount of physical silver, like a mountain of it. They lock it up in a super secure vault, and then they sell tiny little shares that represent that big pile of metal. So when you buy a share of a silver ETF, you basically own a tiny slice of that real physical silver. And the best part? You can trade it on a stock exchange in a heartbeat. So what are the big takeaways here? It really boils down to two things: speed and cost. Since ETFs trade just like stocks, you can react to the market in real time. Price of silver moves, you can buy or sell right then. And because the whole structure is pretty simple, it's just trying to track the price of silver, the management fees or expense ratios are typically way lower.
Okay, let's shift gears and meet our second contender. And you'll see this is a completely different approach to investing, a whole different strategy. We're talking about the actively managed path now.
Yeah, a silver mutual fund is a totally different animal. See, instead of just holding the physical metal, you've got a professional fund manager who takes your money and invests it across the entire silver industry. This could mean they're buying stocks in mining companies, maybe some futures contracts, a whole mix. And think about what that means. The price of silver could be going up, but if a big mining company in that fund suddenly has a strike, its stock could tank, and that's going to affect your investment. So you're not just betting on the metal, you're betting on the businesses that dig it out of the ground. And this is where you really see the practical differences. First off, unlike an ETF, you can't trade a mutual fund all day. Its price is only calculated once a day after the market closes. And that professional manager who's making all the decisions, well, their expertise comes at a price. So yeah, the fees are usually higher. But here's the trade-off. You're getting much broader exposure to the entire silver industry, not just the raw metal. Okay, so now we've met our two fighters. In one corner, you've got the direct, passive play on the price of silver. And in the other, you have the broad, actively managed bet on the whole silver industry. It's time to put them head-to-head and see how they stack up. This is really the heart of the decision, right here. Let's break down the key differences that are going to matter most to you as an investor. Man, this chart just lays it all out perfectly. Look at this. On the ETF side, for trading, you can do it all day long, just like a stock. For costs, generally lower. Why? Because it's passive management. It's just trying to track the price of physical silver. Now, flip over to the mutual fund. Trading happens only once per day. Costs are potentially higher because you're paying for active management, a real person making decisions, trying to beat the market by picking a whole portfolio of stocks, futures, and other assets. So, after all that, we land on the most important question of all. Which path is yours? And look, there's no single right answer here. It 100% depends on your goals and your personal style as an investor. So an ETF might be for you if you're a pretty active trader. You want to react to the live price of silver. And keeping costs low is a big priority for you. If that's you, then the ETF is an awesome direct tool. Your success is tied directly to the ups and downs of silver's price. Simple as that.
But a mutual fund, that might be your thing if you're more of a set it and forget it kind of investor, right? You'd rather hand the reins over to a professional and trust them to handle the complexities of the entire silver industry. We're talking mining operations, market trends, the whole shebang. You're basically betting that their expertise will pay off with better returns in the long run.
So here's the big takeaway from all this. It's not about which one is better. They're just different tools for different jobs. One gives you that direct, low-cost ticket to the price of silver itself. The other offers a managed, broad exposure to the whole industry behind the silver. So the real question isn't which is best, but which tool is the right one to build your financial strategy.